Hi and welcome to Market Vision's Short Takes. I'm Deepak Shenoy and today's module is about how mutual funds are not just for equity investors. Let's look first at the traditional view that mutual funds are risky because they invest in the stock markets and because you don't get a guaranteed return. So you should avoid mutual funds like the plague. The typical conversation goes, that uncle who's a mutual fund advisor kept on asking me and nagging me until I bought a mutual fund and it lost some money in a crash, so mutual funds are risky. But all mutual funds are not for equity. I mean, there's more than just equity in a mutual fund. Let's look at where else. Mutual funds can invest in anything. It's just mutual investing. It's just the concept of many people pooling their money together to invest in something. They have to tell you what they will invest in, but a mutual fund can invest in a host of instruments that are allowed by the Securities and Exchange Board of India, SEBI. Currently, what's allowed is equity, so stock markets, bonds and deposits, a mix of both, gold, other mutual funds, international funds. So other mutual funds meaning a fund can invest in a different mutual fund and can have a range of mutual funds as exposure. Let's talk a little bit about why mutual funds make sense or where it makes sense. First, where ticket sizes are very large, so you can't get into the market yourself. Corporate bonds, for instance, each trade is about 5 crores in size. So if you have 5,000 rupees, 50,000 rupees, you can't even enter this market. But if a lot of people put in their small amounts of money, they could collect 50 crores or 100 crores, and now that mutual fund can trade in the corporate bond market where you can get yields of 9-10% a year, which is not available to most of us otherwise. Economies of scale work in our favor if we do a collective investment. For instance, gold, if each of us had to buy gold, we would have to invest in a safety locker perhaps, or try and worry about the security, about the purity and so on. But if you have a mutual fund investing in it, because of the scale, they can reduce the costs of storage, of security, of purity verification, and this makes more sense as a mutual fund than for individual investment. There are certain markets where you and I are not even allowed to invest, like call money markets, interbank markets. We can't even get in. Mutual funds as institutional investors can get in, can invest in the market. Typically, this is extremely liquid markets. Money is lent for a single day and given back the next day and so on. The return of this is pretty good, sometimes better than keeping the money in a savings bank account, which yields 3.5% currently. So if you were to get access to the liquid markets, you may be able to get 4, 5 or 6% on extremely liquid and safe money. So this market where retail is not even allowed, you can get in through mutual funds. You also have index or algorithmic investing where there may be too much trading because the indexes change on a regular basis. So if you wanted to invest in, say, the Nifty index, the Nifty's individual stocks will change their weightage ever so often. So you can't really keep trading and keep adding a little bit of shares here and there into your portfolio. Mutual investing makes sense. Risk is a different concept. Look at debt, for instance, which is what I call fairly low risk mutual funds. Short term, which are the lesser risky mutual funds, typically invest in the market where you have less than 2 years to maturity on the paper. So they may invest in a short term treasury bill, which is typically less than 365 days, commercial paper, again less than 365 days, 1 year or 2 year bonds, which again have a small exposure in time. They are exposed to some interest rate risk, but typically this evens out because they kind of retain par value within 2 years. So you will recover your money in full if you stay in for a reasonable amount of time. When I say reasonable amount, typically more than 3 months. That's why they actually impose exit loads for about 1 to 3 months. The return on this currently is about 7%, which is more than you get in fixed deposits for 3 to 6 months. Long-term bonds, long-term debt mutual funds hold all sorts of tenure paper from 10 years, 2 years, 15 years, sometimes 30 years. They're exposed to interest rate risk. Interest rates go up, the bond values come down, your mutual fund has risk. But it may be useful as a long-term fixed income strategy for someone who doesn't want to take risk in the longer term. Somebody who's retired, for instance, want to just park the money in a long-term fund and just use dividends to pay off. Exit loads exist again more or less like equity for about a year. If you ask to remove your money, you will get your money in 1 or 2 days. The daily NAV is announced to the AMFI website every day. Again, what's allowed? We've had equity, we've had debt. We've had a mix of both, which is, you could have part equity, part debt. These are called hybrid funds. You'll hear them as monthly income plans, balanced funds, or asset allocation funds, where the amount of equity will vary based on the fund manager's decisions. Gold, fund of funds, international companies, all these carry different levels of risk, sometimes very low. Debt is probably one of the lowest. You have liquid interbank money markets, which are almost close to zero risk. And don't go by the names alone. Something that is called dynamic may not actually be dynamic. Something that's called sector or mid cap may be actually investing in large caps. Mutual funds are just the vehicles to invest in an asset class, not an asset class by themselves. So if you own a mutual fund, it doesn't mean you have or don't have risk. It simply means you're using the mutual fund to invest in an asset class. You have to find out what that asset class is. If it's a debt mutual fund, you're investing in debt. If it's an equity mutual fund, you're investing in equity. If it's a little bit of both, you have that much exposure to each sector, each asset class. This is the end of the lesson. Now we'd love to hear your comments. Email us and visit our forums, and thanks for listening.